Okay, good morning, everybody. We are ready to start the end of week 11 here, and today's Wednesday. So, my plan for today is to talk about the exam, which is due this week and is available. It's been available really since Monday morning, so you have the opportunity to do it. If you haven't done it yet, don't worry. You have till Sunday night to do it. So, I just want to sort of scroll down the syllabus here and see where we are. So, this is and it's going to cover those three chapters. We just covered chapter 13, dealing with CPP, appendix F, dealing with ABC costing, and chapter 14, which deals with incremental analysis, which we pretty much, I think, have covered. There's one exercise that I didn't get to on Monday that I think I'm going to do just to sort of give you a bit of a sort of a diversified look at what some of the range of problems may be, particularly on the homework quiz and bonus, which I moved to the 10th. As I mentioned in class on Monday, that I've been mentioning the whole semester, I've been sort of adjusting these due dates to sort of give you more time. And I mean, the idea of having weeks that there's no activity doesn't really make sense, particularly for a class that meets physically on campus. So we are doing things, and so, but I like to give you more time as opposed to less. I would not wait till Sunday hour to do the homework quiz and bonus. If you're going to do those, I would sort of knock those out earlier. Hopefully, you've already started on those. And if you have questions about how to work any problems, get with me. I'm more than glad to answer any questions. What I'm going to do, and I'll probably leave myself about 45 minutes to talk about the exam and what it's all about, and what some of the tips and tricks ought to be for that. And so I think that's where we're going to go for the majority of the time. But I do want to do one more problem here. Before we get going, does anybody have any questions that I can answer for anyone about any subject here today? We have some people on the Zoom call, and feel free to post your comments in the Zoom link if you like. There's one, I want to do one more exercise that we didn't get to on Monday, just because of running out of time. And that's exercise 14.3. It's on page 1430 in the online or the e-text. And this is one in which, again, in incremental analysis, we're usually trying to set one scenario against another. It's either option A or option B. And as I think I've noted before, that in the real world, maybe it's option A, B, C, D, E, whatever, but nonetheless, the idea is the same, and that is determine what the incremental or the change in the revenue is going to be in relation to the change in cost, as opposed to doing the nothing, which is the current scenario, and determine whether or not we want to do it or not. And sometimes we have to ignore those costs, which we deem to be irrelevant because they're going to be sunk costs or they're fixed costs that are going to be incurred anyway. So those are the ideas. That's the logic behind incremental analysis in general. So let's look at this one. So Moonbee Company manufactures toasters. For the first 8 months, the company reported the following results while operating at 75% of compliant capacity. So what is that telling you there? It's sort of a indication that the firm could do more if they need to because they've got excess capacity, that's excess machinery and storage and warehousing and floor space and all that. So at 350,000 units, the sales are at 4,375,000. Cost of goods sold 2,600,000. Gross profit and all the way on down the line. So this is a little bit different because this is not sort of the CVP statement that we prepared internally. This really looks more like a gap statement based upon the fact that we produced 350,000 units of whatever it is, against toasters, right? And cost of goods sold was 70% variable and 30% fixed. Operating expenses were 80% variable and 20% fixed. And we're going to come back to those in a minute. In September, Moonbeam receives a special order for 15,000 toasters at $7.60 each from the Luna Company. And it's a Mexican company, so we're going to assume that this is not going to be a product that's going to cannibalize our existing sales. We don't know that, but I think it's a pretty good assumption based upon why would they say that. The authors have taken sort of great pains to talk about foreign buyers, and therefore it's not going to interfere with existing sales by making it a lower price. So acceptance of the order result in additional 3,000 shipping costs, but no increase in fixed costs. So no increase in fixed costs sort of tells you that's not really a relevant cost. So we have two things: A, prepare an incremental analysis for the special order, and then B, determine whether we should do it or whether we should not. So that's what's going on here. And let's take a look at this particular issue, and I'm going to sort of bring this up here in order to kind of work on it, and we'll discuss it. And we're going to do this in the very same sort of methodical fashion that we've done the other examples dealing with whatever it is, special order, retain or replace, buy, build, whatever the case might be. So in this case, this is exercise 14.3. And we've really got two choices. Number one, we can say no, and we can reject the offer. And by rejecting it, it makes our life pretty simple because we don't have to do much beyond that. Or we can accept it. And then the issue is, what is the change in net income, the delta symbol, and the change in net income, which is going to be composed of, obviously, as we've talked many times before, the difference between inflows and outflows, or revenues and expenses. But we have to take care here to focus on the relevant inflows and relevant outflows, particularly the relevant costs, which I think are probably most important in this example. Is what are the relevant costs, and can we focus on those to the extent, to the detriment of irrelevant costs? So let's take a look here. So in this case, so what do we got going on? If we accept the order, 15,000 units at 760, well, it's going to affect revenues, obviously. And so revenues are obviously an important component of income. If we reject it, there's going to be no effect on revenues. So incrementally, there's no change there. But if we take 15,000 times 760, which is the price offer, we get 114,000. And so that becomes a consideration here as to net income. When it comes to cost of goods sold, we're given the information, and that is, if there's no change here, then it's going to be zero, but it's going to be basically variable cost per unit of 2,600,000 times 70%, right? And so what do we got going on with cost of goods sold? We're saying that with cost of goods sold, the cost of this is going to be $78,000. Where did that come from? It came from the case itself. We didn't have to calculate it; it just sort of was offered to us at 78,000. And it really comes from this idea that we have the component of 70% of total costs are going to be variable, which are essentially a large portion of this. And so as a result, 78,000 works its way over to this dynamic over here. And then we have operating expenses. Now, this is a little interesting. The reason I kind of like this example is because we're sort of getting out of our prior comfort zone in the sense that we're now dealing with GAAP income statements as opposed to internal statements. And therefore, we're saying, okay, what is the effect going to be then on total income? And we obviously, this is not a GAAP statement we're preparing. We're simply laying out a scenario for management and to decide what's going on. So in this case, there's going to be an increase in operating expenses, and it's going to go to the extent of 31,800. It's going to be zero if we do nothing, but it's going to be 31,800 in additional operating expenses. That's given in the case itself. So as a result, that carries itself over here to the income, net income piece. And so what is the change in net income? Well, and so the bottom line is should we do it or should we not do it? But before we get to that point, we have to decide, is it going to make sense to do it? Well, if we do nothing, there's going to be no change at all. So we talk about net income. We're really talking about the change in net income. That's really what's going on here. That delta symbol represents the idea of what is the incremental difference in net income if we do one thing versus we do nothing at all. Or, and I say nothing at all, I mean, we're talking about doing nothing different. Okay. And that's really what's going on here. So if we accept the order, we've got this increase in revenue, that's incremental revenue, and this increase in incremental cost. And so we do the math here, we end up with an improvement in net income of 4,200, which can carry over here to $4,200. And all else remaining equal, we should do what here? It looks like we should accept the special order because the incremental revenues exceed the incremental costs. And so this is just another example of how we try to get to a decision as to what to do with the special order. Notice what's missing here is this idea of fixed costs, which we don't really absorb anywhere here because we're saying fixed costs are not going to change. And the authors of this particular question sort of go out of the way to make the case that there's lots of operating capacity available. In other words, that there's 75% capacity. They could do much more. So as a result, this is not straining resources. We've got the existing labor, we have the existing space, the machinery, and yes, we're taking a lower price on this product, but we should do it because it makes sense, given the fact that it adds incremental income. And that's why the name of the game, right? Adding incremental income to the bottom line of the income statement. So we should do this order, okay? And not all these examples are ones which we should accept the order. And I think that, and we probably, should, if you're sort of doing what I would sort of suggest to everyone is to do sort of a sampling of problems in the back of the chapter. You're going to see some of these examples that don't work out, and the company should say no and should not accept whatever the special order is or whatever the scenario is. Sometimes it doesn't always make sense to do what we think looks like it makes sense. At the same time, early on in this chapter, this segment, we talked about the idea that sometimes this entire analysis is counterintuitive because we're selling a good that is actually below our total unit cost of production. And why will we do it? Well, we do it because the fixed costs are not going to change anyway, so we might as well do it. And so the fixed costs generally, unless there's an element that does change, and sometimes they do change, unless there's an element that doesn't change in fixed costs, we just eliminate them because we're going to pay them anyway. We're not going to get rid of insurance on the buildings or depreciation of the equipment or salaries of supervisors. In the long run, all that could change, but we're talking about very short-run decisions. And when it comes to the decision rule that we talked about earlier in the chapter, I think I made clear that one of the things where I sort of, I guess, my own departure from the textbook is that we have to set a time limit on making a decision, because sometimes these decisions, buyers who are offering a special price, they're not going to wait a month or 2 months. They need a decision, and sometimes it's like tomorrow or maybe today, right? So, and obviously, if they're pushing the time limit up too quickly, the answer is generally no, because we can't make a decision that quickly. But the time is of the essence, and I think that's the issue. Okay. All right. So, any questions about that? That's the last one I wanted to sort of go over. I want to talk about the exam now, and
so can you just back up 1 second? Maybe
Sure.
I zoned out, but when I was doing the homework, there was a really similar problem to this, and it was tricky. Could you just, how'd you get the 78,000 when you created on 800 again?
Okay, let me go back and see how we got 78,000. So 78,000 is cost of goods sold. So where does 78,000 come from here? So we've got so let me go back to the problem itself, and where's the text? Where's the chapter itself? Okay, and I know this is kind of a bad way to do this because I know we've got the script overlaid here, but so we've got cost of goods sold with 70% of variable costs, okay, and 30% fixed. So we're going to exclude that particular issue there. So we had 2.6 million in cost of goods sold, and I know it's really hard. I probably ought to take this down. It's probably not helpful for me to leave this up here. Kind of move this over here. So we had 2.6 million, and we said that of that, variable costs are the only ones that are relevant. So we multiply that by 70%, we get 1,820,000. And I probably could have worked through this a bit here. I'm still getting, and so we get 1,820,000, and we divide that by the 350,000, which is the current the current production rate, in order to get the unit cost, the unit variable cost, which ends up being $5.20. So so let me kind of work this out here for you a little bit. It's a good question, and I'm sort of going for brevity here, and maybe I didn't quite get there. But so 2,600,000 are the total cost, and the only ones that are relevant are the variable cost. 70% of that is 1,820,000. And at the initial data that was given, and we're going to assume that the variable cost per unit is not going to change in this very short run issue. We had current production of 350,000 units. So if we take 1,820,000, which is the relevant portion of this 1,820,000 divided by 350,000 units.
Did you get the 350,000?
That's the current capacity that was given in the case itself. And the data given were, and this is not the special order. This is the current the current capacity. So the data given, it was sort of a snapshot of the income statement. And it said that if you look, kind of look, let me look up here. It's
Yeah, I don't see that as given.
okay, look at on the income statement. With the little fragment, the little cutaway of the income statement, the sales at 350,000 units. You see it?
Oh, yeah, sorry, okay. Got it.
Yeah, so all we're saying is that at the present capacity, whether we do the current transaction or not, we have 350,000 units, and so as a result, we want to get to the variable cost per unit. So as a result, we do the math here. 1,820,000 divided by 350 is going to be $5.20. That's $5.20 per unit. That's variable cost per unit, and the special order is going to be 15,000 units. And we're not talking about the price here, we're talking about the cost. And as a result, we're going to get 78,000. So that's going to be the cost of goods sold for the special order itself. That's really all that's essentially going on there.
Gotcha.
And in terms of operating expenses, and I sort of cut corners here, and I apologize for sort of jumping ahead. I guess I should have worked out the math, and I apologize for that. But
No, that's okay. This is super similar to the homework, and when I finally got the answer, I still couldn't trace it back.
right, and I think that's part of the trick here, is to sort of keep track of where the numbers come from. Where did you get this? Where did you get that? That's a great. I mean, this is the process of counting, frankly. When it comes to the operating expense piece here, we're sold that operating expenses are 80% of 840,000. 840 is the our total operating expenses. Of those, 80% are variable. So we go back to the original data that's presented in the case itself, and we get this idea of 840 at 350,000 units. 840,000 were the cost of operating expenses. Now remember, and again, one of the reasons why this I think is a little bit tricky is that we're not really dealing with internal data. This is data that we're going to be reporting out on an income statement for external users: revenues, cost of goods sold, operating expenses, net income. That looks like an income statement to me, right? So in this case, the only costs that are relevant are the variable costs, and we're told that 80% of operating expenses are going to be variable. In this case, we have 672,000, which is 80% of that for the $350,000. I'm sorry, 350,000 unit production level. And in this case, since we're doing 350,000, let's just simply take that. This is dollars over units. Now, 350 is the current situation. All we're trying to do is drill down to the per unit operating expenses, that is variable operating expenses, and we get $1.92 per unit. Again, we're not really concerned about the 20% that's fixed, because we're given in the scenario that fixed costs are not going to change. So we have $1.92. The special order again is 15,000 units that this company is offering to pay us, and it's going to be $1.92 that we're going to incur in operating expenses based on our analysis, and it's going to be 28,800, and we are incurring another 3,000. I'm not losing the camera shot here of operating expenses, which gives us 31,800.
Gotcha. Okay. Thank you.
Yeah. I should have broken that out. That's my bad. I was trying for quickness, and that was not a good strategy. Hopefully, let me see if that came through on the Zoom call itself, because I can't sometimes tell what the angle is here. Let me sort of move the camera just to sort of capture that a little bit for you all. So that's what's going on there. So again, we have to kind of work with what we're given, and that is the idea that we've got cost of goods sold and operating expenses, which are the two components of cost. The revenue piece is pretty easy. It's the 15,000 units times whatever it was, $7 something per unit. So we arrive at the revenue. And the revenue piece usually is the easiest in these special order situations, because it's like, here's the deal, we're going to offer you this to produce this many units. And we're going to assume too, I know that in one of my other sections, students were saying, well, wait a minute, what if we argue over the price and we bargain them to get a higher price and whatnot? Well, and we're assuming that the bargaining is done, this is the final price, take it or leave it. And yeah, that's totally, it's a particularly good question, I think. And what if we're not done arguing over the price? We're assuming we are, and this is gonna be a take it or leave it situation for us. So we can either take it or we can leave it, and that's entirely up to us. So, but this is the process by which we would lay out two scenarios and what we do about them. So, okay. In this case, it makes sense to do this order. By the way, one thing I know I think I mentioned this before is these dollar figures don't seem to be too compelling. $4,200 and all the headaches and the angst that we're involving ourselves with. What if we added a couple of zeros to it? Maybe it makes a little bit more sense for us to do it. I wouldn't get hung up over whether or not the dollar figures represent reality in the real manufacturing environment. It's the idea that we're trying to impart here. Is the idea, do we do one thing or do we do the other? And these binary situations come up all the time in economics, accounting, finance. They just really do. Do we do one thing or do we do another? And what do? We have to make a decision. And we've got a limited time frame. And this is why analysis that is prepared to tackle the problem. And accountants, by the way, have laid out these templates early on to decide whether or not we want to do an order or not do an order. And there are a lot of businesses out there that do nothing but special orders because it's more transactional than it is relational. And understanding the cost picture before we get into it really is a critical piece. Okay. All right. Let's see. We got it's about 5 till. We got some time here. Let's. Are there any questions about anything else regarding this particular section of the text or whatever? Okay, I want to talk about the exam. So let's do this. And the exam is available. It's going to be available through Sunday, 11:59 p.m. It sort of goes away. So make sure you're prepared to take the exam before that time. I would not probably wait till Sunday night. Obviously, you're grown people. You can do what you want to do, but to me, it makes a lot of sense to sort of pace yourself, be comfortable, find a comfortable place. It's quiet, without interruption, and take your shoes off and all that. Have a calculator, and probably most importantly, I would say, is to go back in the module in Brightspace and look at there's a product cost sheet which I just dropped, and it's a cheat sheet. I first talked about it back in chapter 13. It looks like this. It says formulas, and it's a really good resource. Just have it available because I think it's going to benefit you to have that there. I would even print it. I know that it's not a very modern way of looking at things, but obviously, how many screens do you want to have up as you do this? But there are some really good formulas here. They're going to sort of make your life easier, particularly when it comes to things like contribution margin and break-even point. And there's a shortcut to get to break-even point on this particular sheet. So if you don't know where it is, get with me. I can direct you to it. And it's just a one-pager. It's a Word document. And I would print it just to have it with you and just to sort of use it. You do have there is a time frame. You have 90 minutes, so you don't have all day, but you have enough time in order to do it. And what's interesting about this is you have, it's going to be 90 minutes, but you only have 35 questions. And it might sound like you're sort of doing the math. It's 3 minutes a question. Oh no, that doesn't sound like much time. Some of these, though, if you're prepared, are not going to take long at all. A few seconds, click, move on, and you should be good because some of these are definitional questions, and I'll get to those and what they're about. So let's talk about some examples of what some of the things that you're going to want to know for the exam itself. And let's see here. I'm going to try. I'm trying to get this up here on the screen. Let's see. Okay. So too many windows open here. So okay. So let's start with chapter 13 first, because remember the chapters covered are going to be chapters 13, Appendix F, which is not really a chapter at all, it deals with activity-based costing, and chapter 14. So let's do 13 first and talk about the idea of fixed and variable costs. And this is a pretty straightforward question. What is a fixed cost? What is a variable cost? We said a fixed cost are those costs which do not change with the level of activity. In the short run, they're fixed, and they're things like salaries and depreciation, insurance. They don't really change much, and they may change over longer time periods, but we've made the case before that in the long run, all costs are variable. But in the short run, there are some costs that are fixed, and so you want to know what those are all about. Variable costs, however, vary proportionally with increases in output. They go up with increases in output and go down with increases in output. That's what makes them variable. They're tied to the production level itself. So fixed and variable costs sort of differ in that particular definition. Okay. And when we talk about cost behavior, we're saying that it really applies to every business that does anything at all, whether it's manufacturing, which is sort of the main thrust of this particular chapter, or whether it's service industries or whatever. We could also make a leap to government entities as well. But all this cost behavior is important because if we understand how costs change with the level of activity, then we can do better planning. Okay. And so when we talk about costs, we really have three different elements of cost. We have fixed costs, which we just define as being those costs which don't change with the level of activity, either up or down. They're going to be constant in the short run. Variable costs, which do. So fixed, variable costs, which do change, and then mixed costs. So mixed costs are what? Those are the costs that have a combination element of fixed and variable. And I really think one of the great examples that the textbook brought out was this idea of renting a U-Haul or a rental car or whatever, where you're given a fixed amount. It's going to cost you $85 a day or whatever, plus 20 cents a mile, right? It's a pretty good example of a mixed cost. But it's applied to a consumer, and we're really more concerned here about the application to a producer, but it's the same concept. And that is, you're going to have some fixed element, and then that you're going to pay whether usage is zero or a lot, whatever that is. And then the variable cost element is going to go up, and it's going to be proportional to usage. And the best example from a manufacturing context, I think, is probably utilities expense, where businesses that produce things use lots and lots of electricity. They're going to pay a fixed cost for it, but they're also going to pay a pretty large variable cost. And so as a result, the total cost is a mixed picture. Okay. We also talk about something called the relevant range. And the relevant range is this idea where nothing really changes, particularly as to fixed costs in the short run. So the relevant range is this, and I know that we talk about this a lot in accounting and even in microeconomics, because I think there's a lot of overlay between this course and micro. And that's the idea that if we're producing between 100,000 and 110,000 units, for instance, that's probably going to be within the relevant range. But if it's choice between doing 100,000 units and 5 million units, we're probably looking at a different relevant range. Because why? Because our cost picture is going to differ. We're probably going to have to pick up a lot more fixed costs because we have to probably add new people and supervisors and machinery and equipment and buildings and trucks and all this warehousing space and all this stuff. So the relevant range is incremental. And this is, as I mentioned before in chapter 13, that it was a pretty good lead into where we're going in chapter 14, where we sort of suggest what's going on with this relevant range activity, but we really flesh it out numerically in chapter 14. So that's what the relevant range is. It's the idea where nothing really changes, and it's where we are sort of expecting to operate. It is, if you want to put it this way, it's really sort of a budgeting concept, frankly, where we say, okay, this is where we think we're going to be in this particular year. We're not going to be anywhere different. And we're going to come back to the idea of budgeting a bit later in the class, where we talk about what budgeting is all about. And we sort of alluded to it a bit, but companies don't expect to go from zero to, infinity overnight. It's incremental, and that's really what's going on. Okay. Okay. Questions so far? So just so know what these mixed costs are about. Mixed costs are an element that contains both fixed and variable levels of activity, so kind of be aware of that. Also, in chapter 13, we talked about this idea of how do we calculate variable cost per unit when all we have is a bunch of data that's sort of spread out, and it's sort of difficult for us to sort of sort through. And one method that we talked about was something called the high-low method. And the high-low method basically took the idea of saying, okay, first of all we have is cost data and production data. I think the first example in the book, I think, was of a cab company that had a certain number of miles driven, and they had cost data, and I think it was 6 months of data. We had another one that I think was a bus company where the quantity was miles driven, and we had, I think, 12 months of data. So whatever the time frame is, how do we split out the fixed and variable components of what are mixed costs? That's really the important question here, because we know that some of these costs are going to be mixed. So the function that we want to look at is this idea of variable cost per unit. And it's going to be based upon the change in total cost divided by the change in quantity. I know that's kind of a little bit wonky, so let's kind of make this a little bit easier. The total cost at the high observation level minus the total cost at the low observation level, whatever that is, 6 months, 12 months, 12 months seems to make sense, right? That's the change in total cost, okay, from high to low versus the quantity at the high and the quantity at the low. And you'll be asked in this exam to do, I think, 1 or 2 questions dealing with the high-low method. It's not as difficult really as what it looks like here, because all you really have to focus on, first of all, the high cost data is going to be associated with the high quantity data, and the low cost data is going to be associated with low quantity. I can't imagine it's anything other than that. And the math itself is relatively easy, and you're going to end up with some kind of dollar figure, because dollars divided by numbers is always going to give you a dollar figure, and that's going to be a variable cost on a per unit basis. And once you have that, you can compute the fixed cost per unit, and there you have the breakdown of total cost. Remember, all total cost is always composed of 2 pieces. Total cost is always fixed cost plus variable cost. And here we're not really focusing so much on product cost in this area of CPP analysis. We're much more interested in talking about cost behavior and budgeting for things like break even and targeted net income, targeted production. And we don't really care so much about the idea of product cost versus period cost. Remember, period costs are those costs which do not become part of the cost of inventory itself. They're just cost of doing business, like CEO's salary or insurance on the building or things of that nature. Okay, so the high-low method is one way to get there. I don't believe there's a question. I'm pretty sure there's not a question on the exam dealing with regression analysis. And I presented that, in a few minutes at the end of chapter 13. It's a more accurate way of doing this. Obviously, you're missing a lot of areas here, particularly this idea of outliers. We have extreme outliers in the high end or extreme outliers in the low end. High-low may not be the best, may not yield the best results, but you'll have an example of that. And so you want to kind of use that particular methodology for that piece of it, okay? Okay, you'll also want to know about how to calculate contribution margin. So contribution margin is probably the most important area of content in chapter 13. So contribution margin is basically this. If you go this is not a GAAP statement, because GAAP income statements go with sales, cost of goods sold, gross profit, right? That goes back to accounting 1, where we have the 3-step income statement. We have the gross profit part, operating income part, and the final bottom line net income. We're not so much interested in what goes below. We are interested, however, in this idea of taking sales, which are still calculated the same way, and we're taking out variable cost, and we end up with something called contribution margin. Okay, this is not a GAAP statement. This is not going to be prepared for the public, and in fact, a lot of times companies do not want to make this information available because it's considered private and strategic, and so therefore it's not available to the general public. But what is contribution margin? And the term contribution means what? These are all dollar figures, right? This is an internal statement or schedule, I guess we would call it. So these are all dollar figures. What does the C refer to? It contributes to what? 2 things that go into contribution margin, and that is fixed costs come out, and then the contribution to net income. Those are the 2 things that contribution margin contributes to: fixed costs and net income. We've already covered all the variable costs, and as we've seen, all costs are composed to be the variable and fixed. So the variable costs are accounted for here. Contribution margin is simply this breathing space that lets us know how much we have available to cover these guys, which are not discretionary. We can't turn off the checkbook and say, we're not gonna pay these, unless we're in dire straits. And then after that, whatever's left over is net income. And for our purposes, we're not interested in tax here. That's not really part of our question. With that, but you'll do a calculation of contribution margin based upon this. And that's really all that you're doing here is this sales minus variable cost is contribution margin. And from there, the two elements that it contributes to are fixed costs and net income. And I don't want to spend a lot of time sort of with explaining and going back over why we have contribution margin when we have a perfectly acceptable income statement, but it's for internal use, and it oftentimes is used to compensate managers for their effectiveness at making contribution to profit. And for those who work in management, sometimes this is a very key metric that top management uses to evaluate their own performance, because managers themselves are subject to review just like everyone else is. And so their big metric are the numbers. And so how much are we contributing to profit? If it's not very much, that's maybe a problem. If it's a lot, that's a good thing, right? So again, we're trying to maximize net income for the firm. And so the one way to do that is to simply get to that point where we are producing more contribution margin, which is a dollar figure. There is a contribution margin ratio, which simply divides this by this, and it's going to be a percentage or a decimal. It's the same thing. And I've got an example of where that might be used here in a second, but that's all we're doing is simply not using dollars but percentages, and based upon the idea of common sizing everything in relation to sales, which is the big thing. And sales is probably more accurately defined as net sales, and that is minus returns, allowances, any discounts or whatever. Okay. All right. Also, break even is an important concept in this chapter. So break even is the point at which the contribution margin and the fixed costs are basically the same. So if these are the same, if contribution margin is 5,000 and fixed costs are the same, 5,000, we're going to have net income of 0, meaning we have broken even. Okay. So it's the point at which those two elements are the same. And break-even analysis is really important because it sort of tells the company where we are, maybe in relation to break-even. We hope that we're beyond break-even, that we're to the right on the production scale, so that we're well above break-even. But yet, it tells us how far we can fall before we get to 0 net income. And 0 net income is simply the break-even point. No company wants to exist at break-even. Okay. And for very mature companies, they're usually well above that point. But think about this. There are a lot of companies that are not mature companies, that are startups. And we have seen lots of startups in the last several years, particularly in the technology area, where they would love to get up to break even. They have a negative net income, probably because they have lots of fixed costs and not very much in the way of sales. So therefore, not very much in the way of contribution margin. Maybe they will get there at some point, and we know there are examples galore of companies that have started out well below break even and have been able to survive, thrive, grow, and get to the point of profitability. Amazon is obviously one, Microsoft another. I'm thinking of technology companies in particular. Genentech was a drug company that had no product at all for years, and their stock traded on the New York Stock Exchange, and people were enthusiastically throwing money at it, because they sort of knew that at some point we would get there above break even. Break even kind of tells you where you are if all you're doing is making 0 profit. Okay. Okay. So know also about there's a formula here in this handy dandy cheat sheet about the break even point in terms of dollars, and basically if you look on the sheet here, where if you've got see if I can find it on the sheet here. Okay, so in terms of dollars, it's fixed costs over the contribution margin ratio. Okay, fixed costs over the contribution margin ratio, which is a percentage. And what is this thing here? It's simply a contribution margin over sales. You have a dollar figure, it's going to give you some percentage, right? That's the percentage. Fixed costs are a dollar figure, and you're going to end up with a dollar figure here. That's the break-even point in terms of dollars. And I I'm going a little bit quickly here, but it's in your on the sheet itself. And how do we get to it? How do we derive this formula? All we're doing is simply getting to a shortcut based upon working the numbers themselves. Contribution margin, which is that difference between sales and variable cost, divided by back into sales, and you're going to get a contribution margin ratio. And it kind of goes back to something which we emphasized a lot in chapter 10, and I think maybe to a lot of people it was maybe a little bit unclear as to why we're getting into ratio analysis and all this idea of common sizing, but we can take everything in relation to sales on the income statement. And sales are 100%, variable costs are 60%, so contribution margin must be 40%, right? And all we're doing is simply putting everything as a percentage. Well, that 40% then can be divided back into the fixed cost dollar figure to get the break-even point in dollars. Because remember, the break-even point is the point at which contribution margin and fixed cost are the same. And so this is one way to sort of back our way into it. It's just a quick and easy way to do it. And if anybody has any questions about the derivation of that, which I went through in class, feel free to get with me. I'm more than glad to go over that. But this is why I think this particular formula sheet is going to be to your benefit to use. Okay. All right. We also talked about the idea of target net income. Target net income basically assumes that we're not looking at zero, but some dollar amount, whatever it is, $1 million or whatever. And so the mathematical methodology is the same, except now instead of trying to get to a zero break even, we're trying to get to a break even. I'm sorry, a dollar figure that's our target. And this is important because in the budgeting context, very often we have an idea of what we expect to earn next year, right? And that is maybe it's $1 million next year. We expect to earn in net income. And how do we get there? Well, we simply insert that for the $0 figure when it comes to break even. So we're not breaking even, we're raising it by $1 million or whatever the dollar figure is. Okay. And so take a look at that. I've got sort of a limited amount of time, and I can't go back and do every problem from chapter 13, but I do encourage you to go back and look at that targeted net income. We did a number of examples in class where we're trying to get to some dollar figure and we're trying to push beyond the break-even point to get to some positive net income figure. Okay, now that positive, that space between the positive net income and break-even is what's called the margin of safety. So kind of know what that is. Margin of safety is the dollar, it's expressed in dollars or also in percentages. Margin of safety is the degree to which, okay, if we're making $1 million a year, it means $1 million is our margin of safety above which we are not going to be breaking even, right? Margin of safety is simply the point at which and it's based upon sales, not net income. So, because remember, we don't really control net income, we can maybe control sales. And so it's the sales figure by which we can drop and get to break even. Not that we want to get to break even, but margin of safety is that cushion amount. And it can be expressed either dollars or percentages. Percentages of what? Percentages of sales. Okay. So that's really what's going on there. It's percentages of sales that we are really interested in. Okay. All right. So I think that sort of does it for chapter 13. Let me see here because I know that we've got some people on the Zoom call. I don't see anything in the chat box, but if you have any questions, feel free to. And those of you watching live can shout out. You're part of the class. Feel free to give us a shout out if you have questions. So we'd love to hear from you. Okay. All right. Let's move on to chapter 14. Chapter 14 deals with what? Okay. Well, just to kind of recap what chapter 14 is about. We said early on when we talked about product costs that one of the complicating and tricky cost factors was overhead. And we said overhead in a manufacturing context, also in a service context, but manufacturing is where we started out with this. It's got really two components. Number one, these are costs which are so indirect, but they're tied to product costs that we really can't tie them to it. We mentioned examples of the plant manager's salary and patrol guards and all that. And so they're just difficult to link up. That's one factor. The other is indirect materials, which is oftentimes associated with materials that are not obvious and not evident as ever having been a part of the product itself. Things like waxes and polishes and heat and glue and all this stuff which is not obvious, and as a final user, we don't really pay attention to, but they're part of product cost. So that's what overhead is. And so the idea is, how do we spread overhead around to get more accurate costing of products? Because remember, if we don't know what it costs us to make a product, how on earth do we know how profitable that product is and whether or not we were making money producing it? So activity-based costing is one way to get a little bit more accurate with that. And it's based upon the idea that we're tracking the activities of the business itself, and we're assigning cost pools. And I'll come back to some of that more in a second. So ABC, which stands for activity-based costing, is an alternative to what we call traditional costing systems, where direct labor was what we call driver. That is, we simply pick up labor hours, we assign an overhead rate to labor hours, and therefore, whatever overhead's being incurred, we make it as a function of labor hours. The problem with that is that manufacturing is so more complex now. It's not just about labor, it's also about materials. We have high value materials, and so sometimes machine hours might make sense as the driver, maybe inventory moves, maybe purchase orders, who knows? It really, and it can also differ in the service context as well. But the idea is to try to get more accurate with the amount of activity going on. And whatever the activity is, we simply say, okay, this activity accounts for this much of total overhead cost, which we're going to budget. And where does that number come from? It's not just pulled out of the sky. It's probably based upon prior years' experience, and also with a little bit of prognostication as to what's coming. And so we drop the dollar figure of total overhead into different pools. And then what we do with those pools is we measure the activity itself, whether it is labor hours. And labor hours is a perfectly acceptable driver, but it's not the only driver. We say it's traditional, and it's been used for a long time, but there are companies, I think your text talked about, uses hundreds of different drivers in cost pools because the contribution to total cost is so much more than just labor. And so that's really what's going on. So direct labor in the traditional method is the sort of go-to driver, as we say, okay? Okay, when we talk about product cost, we talked about this idea, and we've been down this road before. We said this goes way back to where we talked about direct materials, direct labor, and manufacturing overhead. And we said these two guys are what we call direct costs. And they're relatively straightforward. We simply measure them, and labor is probably the easiest of all in this particular context, because even indirect labor is not that difficult to account for. Manufacturing overhead, however, is what we call indirect costs. And so that's what makes it a little bit challenging, is the idea, how do we take all these indirect costs, which may be substantial, and how do we attach them to the product itself as we're making products in order for us to decide whether or not we've got profitability of this product or not. So know what this idea of direct versus indirect costs are about, because it really is an important piece of this, okay? And so, and there's a methodology. If you go back to Appendix F, which is in the textbook, it's not a chapter, it's an appendix. There's a 4-step process for assigning overhead costs to units. You got to determine what the activities are that we're doing, and therefore establish a cost pool, allocate the overhead cost to those pools, find out what makes those pools generate cost, like labor hours, machine hours, movement of inventory, set up some machinery, whatever, and then figure out that amount assigned to the pool divided by those quantitative numbers of drivers, and that gives you what's called a predetermined overhead rate. And we had a discussion activity that talked about this idea of, which you didn't have to do the calculation, but just to establish the idea of an overhead rate that we can apply to whatever we're doing. It's the piece of this that is not easily measured because it's so indirect and so we need an alternative way of doing it. So that's really what's going on. So take a look at that method. It's a 4-step method by which we can get there. And so you may want to have a look at that in your book. Okay. Let me see here. Okay. So we talk about pools, right? And what are these pools? Well, the pools are simply dollars that we drop into an activity that's relevant to whatever it is we're doing. If labor is the major activity, and it is in the service context, then the pool is simply all the cost of labor that we drop into a pool. And accountants love the idea of pools. It's a way of segregating financial data from one another and assigning them to different places depending upon what we're doing, what we're trying to accomplish. In this case, we're trying to accomplish the idea of assigning product cost, overhead cost to individual products themselves. And so if we determine what the activities are, whether if it's labor intensive, then maybe the traditional method is perfectly fine. But if it's a very high-tech and sophisticated manufacturing operation, maybe it's machine hours. That's a very common one. Maybe it's machine setups. Maybe it's movements of inventory, across the production scheme. Some of this is, and some of it, can get very complicated, and we don't want to get too complicated with this, other than establish the idea that the pools are simply the dollar figures that have been assigned those overhead costs which attach themselves to the activity itself, usually based upon prior experience. Okay. All right. So you'll be given, I think there are probably 2 or 3 examples in the exam about applying these overhead costs and to particular activities themselves. And so if you're not as comfortable with this, or it's been a couple of weeks since we looked at this, I would do some examples in the back of the chapter, and particularly the ones that have the quick feedback, the little blue button you can click, and do some examples of what's going on. Basically, it's the idea of simply trying to get to a predetermined overhead rate based upon what is allocated to the pool and how we're measuring the activity that we expect to incur. And knowing, of course, that we're probably not going to be perfect. It's an estimate. And we talked about this idea of variances, and we're going to come back to the idea later in the next bit of the course to come. But it's a better way of assigning overhead to an area that is very much indirect and is challenging. Okay. All right. So know about that 4-step process. Know what that's about here. And there are a couple of questions dealing with what are some examples of cost pools. This is a pretty easy one. So just kind of look in your in the appendix. What are some examples of cost pools? It could be labor hours, labor dollars could be a cost pool. It could be machine setups, could be machine hours, it could be all these things. That's a pretty straightforward one there. So you kind of want to look in your text for some examples of what those likely pools are going to be. Okay. And then we also talked about, we did some examples in class in sort of the back of the chapter exercises. We're producing maybe 2 products and we're assigning overhead to different products themselves. And there'll be questions about how much do we absorb into product A, how much to product B. Have a look at those. Make sure that you're familiar with what the process is. You've got to establish an overhead rate, first of all, and that makes sense for that particular product. And it's simply the dollars assigned to the pool divided by the number of drivers. That's the overhead rate. And then you get the actual, and you multiply the actual by the overhead rate, and you can apply that to the cost of the good itself. Okay, the product cost, that part of manufacturing overhead that goes into it. Okay. And I'm going a little bit quickly here, and I know that, and I know sometimes people say, wait, slow down a little bit. And I know that I'm going quickly because I don't have only been a limited amount of time. But I'm just kind of going over some of the things that we've talked about previously, and it's not cost effective to go over all the things I've talked about before, but just to kind of point you back to where we are. And if you do have questions, feel free to reach out to me. I'm available. And if you want to know about how we do product A, product B, overhead costing, it's an important thing to know. And let me know if you do have questions about that. So we talked a bit about, as we sort of wrapped up in Appendix F, the costs and benefits of ABC. And some of the benefits, the benefit by far, I think, can be said, is you're going to get more accurate product costing. You're not going to be getting some arbitrary cost application of overhead. You're going to get that's much more akin to what it is you're actually doing and what it is that generates cost in the first place. Maybe it's not labor so much. A lot of companies don't have that much in the way of labor. Instead, a lot of their output is, and the cost of the output is traced back to, it's indirect, but it's machine output. So we have to be clear. That's the main benefit, is better cost assessment. Okay. Some of the drawbacks are it's expensive, it's complicated to maintain, and as I mentioned before, I think that a lot of smaller businesses would be really, I think, hard pressed to be able to apply ABC costing, even though I think it would make sense. I think if they would be able to apply it, I think it would allow them to better determine the profitability of individual projects, individual products, individual product lines, because it really is a better way of capturing this category of cost. Okay. So to sort of get to the end of Appendix F, we also talked about toward the end what are called value-added activities and non-value-added activities. And this goes to something called activity-based management, which we're going to, it really is a little bit beyond this particular course's scope of inquiry, but we kind of open the door to it because it's a really important management tool that takes accounting data into account to assess the effectiveness of management. And that is management, if they can control the value-added stuff as opposed to the non-value-added things, then it's a way of measuring their performance. We can't hold management responsible for things like the cost of postage. I mean, that's out of their control, or even maybe the cost of freight. That's not really in their control. Yes, they're important activities, but they're not really value-added. And if we take this to a sort of broader picture here, value-added also is a perception on the part of customers. And customers really could care less how they get their product, what trucking line brought it in to the store in which they bought it, or whatever. It makes no difference. These are things that really add value to customers, and so, which is why they're called value-added. So we want to sort of differentiate what those are all about. Also, we want to make clear that ABC costing can apply really to all industries, not just manufacturing, even though I know, and we've said many times before, that we do have a definite manufacturing orientation to a lot of college accounting courses. It's kind of a legacy, but and the idea is that these concepts apply also to service industries, so they do apply as well. So service industries are much faster growing in the economy generally than is manufacturing. Not that manufacturing is dying, like some people want to say, but rather services are growing faster. Services are growing faster than manufacturing. Okay. All right, let's go to the final chapter here. We've got about 12 minutes. And so when we talk about incremental analysis, which is what chapter 14 is about, there's a set of steps that we go through to figure out what we're doing with incremental analysis. Remember, incremental analysis is the idea of we're taking accounting data and accounting information to use it to make decisions that are not in the sort of quote unquote normal course of doing business. Do we repair or retain a piece of equipment? Do we buy or do we build? Do we lease something or do we buy it? These are all sort of laid out as being either or kind of scenarios, situation A, situation B, and it could be A, B, C, D, E, but I think we sort of made our case with the idea of A or B and as a sort of a binary. And so know about these steps that are involved in it. And one of those is assigning responsibility for figuring out who is going to solve the problem. It usually falls to the accounting or finance people. Accounting staff oftentimes fall under the finance area of a corporation, particularly in managerial accounting. In the context we're talking about here, usually finance is sort of the overarching operational area, and then accountants are sort of one piece of that. And they're often tasked with deciding, do we do something, do we not do something, do we do the numbers? Top management oftentimes doesn't want to crunch numbers. And I know this may or may not be a shock to people, but top managers do not want to sit and work on spreadsheets. They want other people to do it for them, and they want to be given a recommendation. Yes, no, how much, all that kind of thing. That is not what they think their job is. And so as a result, they assign it to the accounting and financial staff to work out. So that's what's going on there. Also, when we talk about these decisions, we're talking about these relevant variables. What is relevant? And we're talking about things like variable costs are almost always relevant, and fixed costs usually are not relevant. We did see some examples where the fixed costs would be relevant only because the change in fixed cost would be apparent because of one activity or one choice versus another choice. And so that change, that difference becomes relevant. So relevant costs are those things which are going to change if one decision is taken versus another. If the variables are not changing, then they're not relevant at all. And there are some variables that are never going to change, and they include things which have been incurred long ago that we call sunk costs. Sunk costs are those costs which have long ago been expended. If we bought a piece of machinery 5 years ago, the cost of that machinery and the accumulated depreciation and the current book value really are not relevant. They are what they are. They've been incurred. We can't go back and change the past. All we can do is sort of take the present in order to go forward. So those are costs which, they're not relevant. Advertising costs in the past are gone. They're done. They're not, we can't get them back necessarily. So we have to know what are true costs, that is relevant costs that we can do something about, and those which are not relevant that we simply refer to as sunk. Okay. Okay, I got about 8 minutes. I think we have enough time here to do this. So remember, a lot of what chapter 14 is about is where we spent the first couple learning modules talking about definitions and what incremental analysis is, why it's important, why it's a useful skill. I told the class, I said, this is where I think accountants earn their pays because they apply all this rigorous spreadsheet analysis to a particular problem that's dropped on their lap. They've got to make a decision, right? So incremental analysis is got lots of important areas in this regard. And a lot of the rest of the chapter, beyond those first couple modules, are dealing with specific scenarios: buy versus build, stop processing or continue processing further. We have the example of the dairy products where we started with, we have two joint products. Remember that? We have, what was it? Cream? What was it? Skim milk and
Cottage cheese.
I think cottage cheese was the end product, and what was it? What were the two original products? I think it was. I think right. So you had two income streams, and joint products are very common. And I know this sounds kind of grotesque, but a lot of things having to do with cows have joint products. You've got leather, you got meat, you got dairy. Obviously, you can't eat dairy cattle usually, but you got all these products that sort of split out from it. And the idea is, okay, what do we do with these raw materials, these products? We have milk. What do we do with it? Do we keep processing it to make cottage cheese, or we sell it to somebody else? Do we keep processing the cream to make what is it? What cream? I forget what the final product is on that stick.
Cottage cheese.
Yeah, right. That's right. On the skim milk, that's milk. Right. So, and it's not an ambiguous question, really, and it's not that unusual. Companies oftentimes decide where they stop processing, where they go forward. Think about this: we have lots and lots of output of producers in the economy whose work stops before the good is even ready to be picked up on a shelf. All the output of farmers. I mean, farmers produce output that is not available for our use. They produce corn. A lot of it's made into to feed for animals. You can't really eat that corn. That's not available for you. So the wheat, you got to process it. And the same goes with dairy, and which is the example given in the text. So there's lots of output that's produced. A company that cuts down trees. Well, those trees aren't ready to be made into paper or paper towels. They've got to be processed further. Somebody's got to do it. They can do it. They go all the way from start to finish, raw materials all the way to final good. It's really not often that done. There aren't that many companies out there that starts with something that comes out of the ground or out of the earth by virtue of our being with it to make some final product. So, and it's a question that comes about in the sense of, where do we stop? What is the end of our business, and what is most profitable? And should we pass it off to somebody else who can do things better, cheaper, and faster? And or do we want to try to go all the way to integration? This is so many areas of the economy have these questions about selling or processing further. It's really important. And energy is an industry that I've been involved in for a long time. There are all kinds of actors involved in energy, oil and gas production who only do a limited piece of the puzzle. That's it. And somebody else does, and the thing gets processed. And we don't really, as consumers, we don't really care who pumped the oil, who refined the oil. We just want gas in our car, right? And somebody's got to do it, and that's the question of who does it, and they do it based upon a rational bit of analysis. Okay, all right. When we talk about, so one of the examples was special orders. That was one of the examples. Know about what's going on there, what kind of costs are relevant. We also talked about make or buy. That's really a classic decision. Make or buy, or build or buy. That is, do we make something or do we buy it? The example we got was one where they were making some component parts, or they could buy them, and that was the scenario in the text. And the question is, what do we do? Do we just go out and buy the finished product, or do we make it ourselves? And that's a really important. It's an important decision to be made. Companies all the time are deciding they don't want to make certain things. They would rather have somebody else make them. And if you take a look at certain products that are very sophisticated, like cars, you have thousands of different components made by companies all over the world, and they're done because it sometimes makes better sense to buy them from somebody than to make them all your own. So, I'm a big fan of Peter Drucker, as I mentioned before, and he talked about the idea that sometimes you just have to recognize your limitations. And if you can't do something better, cheaper, faster than somebody else, then let them do it, and you stay out of it. You stay in your lane. I think that's an important issue. Okay. We talked about joint costs. I'm about out of time here, but I'm almost done. Joint costs are those costs which attach themselves to multiple products, particularly from some source. So trees can become timber well, timber becomes things like lumber for building, or pulp for making paper and whatnot. Those are joint products, and the joint costs are associated with those to be split off. And then there is something called the split off point. I just mentioned split off. Split off is where we decide, okay, these products are going to go different ways. And the example given in the text was that of milk that was created from the dairy cattle. They can go different directions. And that point at which the output goes different ways, it doesn't have to go two ways, it can go multiple ways, is what we call a split off point. There are all kinds of examples everywhere in manufacturing where trees are cut down. Timber goes one way to become lumber, pulp goes another way to become paper products. Oil is a great example. The refining process makes gasoline, it makes waxes, it makes kerosene, it makes motor oil, it makes all kinds of all these different products. They're all splitting off at different points. And I don't want to get overly complicated here, but it's just something to consider, that some products become multiple products, mostly because of the virtue of what that raw material is to begin with. Okay. And then also we talked about the idea of retain or replace. And keep in mind, one of the relevant costs is the replacement value. It's not just the cost of buying new equipment, but also if we buy new equipment, maybe we can dispose of the old equipment and get a cash inflow. And so that's a piece of the puzzle that we should take into account. Okay. So I think that we've got about a minute left. I think that's really all that I wanted to go over for the exam. Are there any questions that I can answer for anybody with regard to this? Let me take a look at the Zoom room here and see if anybody has any questions for me. Where's this? Okay, there you go. Okay, well, if you think about something in the meantime, get with me. We've got till Sunday, so there's plenty of time to do this. We got today, Thursday, Friday, Saturday, Sunday, so you get plenty of time. If there are questions, let me know. Get with me, and I'm more than glad to sort of work through some of the questions. Sometimes people have questions about individual problems, and I may ask them to screenshot or whatnot, but that's just kind of a way to get me familiar with what you're asking about. Okay. All right. Good luck on the exam, and I will see you all next week.